Hello, hello. Sound check 1 2 1 2. Happy Saturday morning to you, friends. Hope you're doing well today. Just making sure everything is good to go, making sure my computer confirms that we are live. Believe we are. Let's do this intro. Hello. Welcome, friends, to Alpha Beta Soup Live. I'm TXMC. It's your boy. It's December 2nd, 2023, Saturday morning here in beautiful Austin, Texas. Good to see everyone. I did a little experiment with my stream today. I didn't mention it on Twitter at all. I decided to just use the power of YouTube to see if it would produce the same kind of audience. So it'll be a little experiment we run today. There's about 60 of you here, a little bit less than we had last time, but that's to be expected with my change. I just kind of wanted to see how much of the audience comes from people waiting for my tweets versus folks who have me subscribed and see the notification on YouTube. So doing that a little different today. What we'll do, we'll look around at the markets and see how the month closed for November. Pretty impressive candles kind of across the market. And then, just kind of talk about what's been going on. I don't have like a big specific chart I want to show you guys today. We'll just kind of bounce around and see what's been going on and just kind of take it from there, have a little go with the flow kind of session. Sorry, I put this off for a day or two. We usually do the streams on like a Thursday most of the time, but I just kind of had a busy end of the week and it crept up on me really fast. And by Friday morning, I wasn't quite ready to do one yet. So we're doing it today. I see a few of my friends in the chat: Sick Thinker, Oscar Hernandez, Ryan Rendon, Obaid Ali. I see all you guys. A bunch of other folks I usually see in here. Good to see everybody. So let's look at the charts. The uptrend on Bitcoin still looks good. This kind of choppy action on like low time frames, this just relentless grind higher, I think is the kind of price action that can really chop people out because people are waiting for volatility. There's a lot of traders that just keep waiting for some like pixel perfect pullback, like down to prior resistance. And it never quite manifests. Like every time it looks like it's going to do that, it just turns around and reverses higher from like a higher level of structure. Like we did right here. Never really quite came down. People keep trying to play this like range trading. Oh, well, here's the high, here's the low. We just swept the high, so I'm targeting the low. But it never really quite does that. Sometimes it doesn't even go 50% back across the range. So just for technical traders, this can be a pain in the ass. But if you have a long position from anywhere back here, you can just continue to ride this structure. Like if you're just trading it, I'm not talking about people who have a long-term investment bag, but people who just were trying to play this breakout or play this move. Like, I have longs from, where's my long? I think it's right here. I think this is where my long is. Yeah, 35.6, something like that. And I'm still riding it, right? Like each time we get a new invalidation, I move my stop up. I think my stop is here now. And that's fine with me. If we pull all the way down here, then I don't want to be in the trade anymore. But it's continually pushing higher, right? We've had no real threat to a breakdown in the structure. And so when you look at it on a daily chart, it still looks good. When you look at it on a weekly chart, it looks really good. It looks very strong. From like a support perspective, we're kind of finally getting into the really interesting parts of the market here. So if we just kind of mark out some of these levels, that one looks like that. So we've kind of had these ranges to move in, right? And when I'm looking at this, I don't have big long-term predictive powers, but I can identify market structure and kind of break things down into ranges. And that's easier for me to interpret than trying to like figure out where the ultimate price is going to be from right here. I have no idea. But what I do know is that we've had these level plays, these kind of level to level plays. For a lot of the earlier part of the year, we were looking down here at this level, the Luna Wick, which had marked a really important pivot zone for the consolidation for most of this year and part of last year. But we broke higher, right? And we're just kind of moving level to level through Bitcoin. And now we're getting up into this zone where we created this massive upthrust. This is 2 separate weak candles right here before the big sell-off, right? And so I think the next most interesting area for price, oh my God. I think the next most interesting area for price is right around in here. Now that looks like a big box. It's from 42 to 46. It is a big box, but this is a big weekly candle right here. This was a 13.5% weekly candle from March of 2022. And this was during a period of time when we had Do Kwon from the Luna Foundation and Michael Saylor from MicroStrategy, both publicly TWAPing 9-figure stacks. They were buying massive Bitcoin positions during this period of time right here. And price never really was able to get back over 48,000. A bunch of people sold into this. They were very public about their purchases. And there was a bunch of distribution up here. And it created a really big supply zone. That's what we call this here, this upthrust before the down move, this big candle. And I think that's going to provide some friction. It also just happens to be, from like a technical perspective, it just happens to be right around the halfway point of this zone that I've marked out here, this next kind of area of consolidation and supply. So I think this will be tough for us to work through. I don't really know where the actual top will be, but that's where I'm going to be watching the price a little more closely when we get up into this area to kind of see what it does. It would make sense for it to pull back in here and maybe kind of chop around a bit, but hopefully continue this kind of relentless grind. If we look around at some of the other coins, they don't look quite as good, but they still look good. Ethereum has been flagging here. It's underperforming Bitcoin, but it's pushing towards range highs, right? We've got all these wicks up here. It's pushing up into them. It looks a little better. On a weekly chart, it's still maintaining the trend, right? It still looks good. But just from like a structural perspective, it's finding a bit of resistance. And that's fine. This was a big candle, right? This is another big supply area right here. We have this massive upthrust, which led to several months of this kind of sideways downtrend for Ethereum. So it makes sense that it's going to churn through this in a similar way that I expect we will eventually have to churn through this area for Bitcoin. Same kind of concept. But the next area up for Ethereum is up in this zone here, around 2,500 or so. It doesn't have to be pixel perfect exact, but this is an area where you saw price consistently struggle to get below it until the major sell-off. And Ethereum has its own kind of supply zone here, the same way Bitcoin does. It looks a little different, but it functions in much the same way. So I think, depending on what the economy is doing, depending on the markets, depending on how quickly it takes for us to get up here, I think this zone will be difficult to work through in much the same way that this level has been difficult to work through. We'll see. That's just kind of how I'm thinking about it, looking at it here. Total market cap for crypto also looks pretty good. We're maintaining the uptrend. We're finally above like a year and a half of resistance right here, and there's not a lot of action really in this area. It's kind of just a void, up until this higher zone, up until about 1.6 trillion, kind of like up in this area here. The same area we've been drawing lines on Bitcoin and Ethereum. The structures are really similar, so I think this altcoin rally's got some more legs, even though we talk about recession a lot on here and those things haven't really changed. There's a delay in how long those things take to manifest. And really the end of the cycle, if we're correct about any of the recession stuff, the end of the cycle is often the most bullish time, right? We've talked about the pause rally. We talked about that last week, about how when the Fed is done tightening after a period of raising rates, that is often some of the most bullish price action for equities. And it makes sense that the crypto's also rallying around this time. It's not really outside the realm of normalcy to see this kind of action at this point of the cycle. Everyone's also getting really excited. Emotions are starting to rise. You're starting to detect the potential of a euphoric soft landing nirvana just taking over the market, right? Despite the fact that, as you guys know, anyone who follows the channel here, there is a compendium of economic data that doesn't look good, and it's very slowly trickling down and retracting in its rate of change. But that is a very slow moving process. Right, that's a molasses slow process, whereas the crypto markets are very quick, very fast to react, very volatile, and so those things don't always play out together. Risk markets generally more volatile, and they react more quickly, and they will continue to move higher until the economic data is too strong to ignore, and we may still be a few months away from that happening. So we're in a really interesting place here. When we go look at equities, man, look at this monthly close right here on the Dow Jones. Right here. Look at this monthly candle. Just absolutely destroyed all of this buildup right here. Look at that. That is a 8.7% monthly candle on the Dow. That's a big monthly candle. The last time we had one anywhere close was a year ago at the market bottom when it bounced 14%. That's a huge close for the Dow Jones. The weekly also looked really strong. I mean, look at this, just 5 weeks of straight up. And we called this here on the channel really well. We were bullish at this point. We noted there were bullish catalysts that could likely provide tailwinds through year end. That was around the Fed pausing for a couple of meetings in a row, signaling that they're probably done with rate hikes, borrowing some kind of surprise. And also the Treasury issuing less long-term bonds, like less duration to the market. Those two things really reversed everything. And we've all just been ripping ever since, while yields have been crashing, while real yields have been crashing. So these moves in equities are really strong. And I think that because we're through the retracements now, let's slap this fib on here. Because we are well through the retracements and we are well beyond the highs from the pivot, I think it makes sense. We're looking for all-time highs now. Looking down here, thinking it's just going to reverse in the middle of this void. Maybe it does that. But I think the overwhelming probability here is that we're going to find out what's above 36.9. I don't really know how far it's going to go higher, but I know I've expressed my thesis on here before that the Dow Jones and the NASDAQ both still have some room left on their long-term, like 20-year secular bulls, whereas the S&P has already reached that point. Maybe the S&P benefits from these other two beginning to run. Maybe there's some kind of an intermarket rotation that happens that lets the NASDAQ and the Dow move higher and complete their 4.236s, while the S&P maybe doesn't. That's possible. That isn't impossible. There are different stocks in each of these. It's more possible for the NASDAQ to do that than the Dow, because most of the Dow Jones is in the S&P. But there's quite a bit of the NASDAQ 100 that is not in the S&P. And if those stocks, if we can identify that those stocks are outperforming the other components of the NASDAQ, or even the other components of SPX, then that can lead to the NASDAQ completing this structure, while maybe the S&P doesn't rip all the way up to 52 or 5,400 or whatever that would imply. That's just me speculating. But in an attempt to understand this, I made an indicator. I decided to make an indicator because my thought is, if this thesis has any merit to it at all, then I would assume we might see outperformance of the NASDAQ over the S&P and the Dow Jones over the S&P, right? That's why, if you notice on my watch list over here, I've added the NASDAQ future over the S&P future, and the same thing with the Dow Jones over the S&P future. And I've been watching them. And interestingly enough, the Dow Jones has been greatly outperforming the S&P recently, though the NASDAQ has not. So we've seen one of those two elements doing what I thought it needed to do in order for these two to complete the structure that the S&P's already completed. But I made an indicator, like I said, and I'll show it to you here. This red line down at the bottom is the NASDAQ 100 here in the middle, and it's the stocks in the NASDAQ 100 that are not in the S&P. And so what I've been looking for is to see those stocks and to see how they perform and whether there's any signal in there at all. And this might be complete nonsense, but as an analyst, as a curious person, I have to explore these things, right? And just kind of see what lies under the tree. I got to lift up the branches and find out. So I made this indicator here that I call NDQXSPX. This, like I said, this is the NASDAQ 100 minus all the stocks that are in the S&P. So it's just NASDAQ 100 stocks. They're not in the other index. And what is fascinating about this is that it looks almost exactly like Bitcoin. Look at it. This is Bitcoin on the top. This is Bitcoin on a line chart. So all we're seeing is the daily close. We're not seeing all the wicks and the noise. But it looks almost the same. It's crazy. Look, run up in early 2021, big fall, run up again, barely sets a new all-time high, rolls over all the way down into Q4 of last year, and then has turned around and is now ripping higher on the breakout, just like Bitcoin. Isn't that fascinating? These are the stocks that I said in my thinking needed to really show us some outperformance. That was going to be the way that the NASDAQ could push higher without the S&P doing quite as much. And whether that's true or not doesn't matter as much as the fact that it's almost identical to BTC. And so then one other thing I thought about was, wow, that's interesting. How do any of these dates line up? Like, does it match with some of the pivot points on Bitcoin? And there's some interesting symmetry here. So I put vertical lines on some of the key pivots of the red series down here. And so one of them, the initial pullback here in early January before the move up that became the first high, came at the peak of the run up for Bitcoin before its first pullback. And if you guys have been on my channel a long time, one thing that's really interesting about this period of time here, this January 2021 period for Bitcoin, is that this was the end of the on-chain bull market. This was the end of the technical, like, underlying relative strength of the market, bull market for Bitcoin. This is where we had the blow-off top in on-chain activity. This was the high for RSI. This was the high for spot volume. This is where we had most long-term holders distributing. It was all right in here. It wasn't over here. The market really exhausted itself in this period of time. And so anyway, that's an interesting little sidebar. We can maybe spend a different stream where I show you guys all those charts for those of you who haven't seen all that stuff, because it's been a while. But let me focus on the dates here. Sorry, I just get real excited. So the low here matched that high. The absolute Pico high in February came during this period, not quite as an impressive of a place. However, the low right here, the low from May of 2021, was at the rollover point for Bitcoin. This is right around the time when Elon went on SNL and we had Doge ripping. It was like a week before China banned industrial mining and we had the big drop off in hash power. That was all right here. That was the low of this series. And it began to climb, and where it reached its high, the absolute high, to the exact day, was September 7th. That was the day that Bitcoin was legal tender in El Salvador, and we had a 10K red candle on Bitcoin. That was the mid retrace peak for Bitcoin to the day, was the peak of this series, this NASDAQ X SPX. And to the day that it had its retrace rally was the peak of Bitcoin. To the day, November 10th. And then it fell, right? As Bitcoin fell, it fell. And right around this point, Bitcoin started to flag in the first part of last year. And this started to kind of consolidate and chop around. And its high was right here. Its high was to the day, the high of Bitcoin's retrace rally before it rolled over. To the day. So this is crazy. It's just crazy how well it lines up. I had no idea it was going to line up this well. And when you look over at the retrace, excuse me, you can see where BTC is. BTC is still trying to get to its 50% mark, and maybe it goes a little higher. You know, we're thinking maybe it gets up into this area, 618,702. That seems optimistic for me, around 50K. This series is just about to reach its 702. So it's kind of in an interesting place. I don't know where it's going to go. I don't really know if this is meant to be leading Bitcoin or if there's supposed to be this kind of correlation. But it's curious enough that I'm going to start paying attention to it. I'm going to try to learn from just watching this series and seeing how it performs. It's also interesting to note that this is at the 702, while the NDQ, which is what it is derived from, you know, it's a part of the NASDAQ. It's the NASDAQ minus all the stocks that are in the S&P. And if you look at the NDQ itself, it's all the way up here, right? It's well past the 786. It's like, you know, 85% retraced of its full move here. Whereas this one is still all the way down at the 702. It's trailing behind, which suggests to me that it has more to go. And so if this is going to continue pushing up, these stocks that will move the NDQ but not move the SPX, then that is the potential avenue for us to see this complete while the S&P doesn't. Does that make sense? Am I crazy? If I sound like a total regarded moron, then please tell me. But it's just kind of like, it's fascinating to see how this lines up. It's really interesting just to notice how closely related Bitcoin has been to the traditional markets. And, you know, a lot of people that I follow and that I interact with on Twitter are very myopically isolated on just looking at Bitcoin. And every time the price moves, it's because something about Bitcoin has changed, something about adoption, something about institutions, something about the government, something about people understanding sound money. There's always some narrative that gets applied to why the price is doing what it's doing. But if you just look at any other market, it's doing similar things and it doesn't care about Bitcoin, right? None of these stocks here care about Bitcoin, yet they pivot and move at really close periods of time. And just to add one more layer of like, that's weird. If we just measure like peak to peak on here and trough to trough and things like that, it's pretty close. Like they're very close to each other. And I just think that's really interesting. And it suggests to me that maybe there's like a 60-day, 2-month roughly delay between major pivots on this series and major pivots on Bitcoin, right? Because right here, the peak of this series to the first peak of BTC was 56 days. Their low to the summer low of Bitcoin was 68 days. Maybe it's 67. I don't know. Maybe I'm off by a day. Up here, the peak for this series to the peak absolute for Bitcoin was 61 days. So this is about a 2-month delay. So another thing to watch for, if I'm going to pay attention to this series, is to watch and see if it begins to roll over and perhaps Bitcoin has not. Then maybe that means we're getting into crunch time. Maybe it leads it by 60 days again. I don't really know. But I've been playing around with this week, and I just keep finding all these weird symmetries, and I don't quite know what to make of all of it yet. But it was interesting enough that I wanted to share it with y'all. And some people have asked, and I see you in the chat, did I share this with BCB? Yes, he was the first person I showed this to, because he and I have been talking quite a bit about this dynamic and like how could we see this play out? How could we possibly see outperformance from two indexes over the other index when they share a lot of the same family members? And this is what led me down this rabbit hole. It's also possible that we never talk about this again. Like maybe this series proves nothing. Maybe it rolls over. Bitcoin keeps going higher. The rest of the markets keep going higher. And this proves nothing. But It was interesting enough for me to want to look at it. I'm going to save it, NDQXSPX, and we'll check on it now and then, and we'll just kind of see like what it's doing. So anyway, I thought that was interesting. It looks like it has more room to run. It's trailing the NASDAQ in terms of retracements, and it leads Bitcoin by 60 days on average, or at least it did in 2021. Over here, if we look at the low, this low actually lines up with the equity low. So it's not really special for this series. It's the same day as the low in the stock market. And it was about a month, 38, 40 days before the FTX low for Bitcoin. So this one is less, it's the pattern breaks a little bit from over here. So maybe it leads by a month and a half, 2 months. Maybe it doesn't. Something to keep an eye on. I noticed there's some people saying some things in the chat. So let me pull this up, see what I missed. If you are watching me, please make sure to hit the like button. There are about 80 of you that haven't done that so far. So if you could hit the like button, I would appreciate it. If you could subscribe to my channel and turn on the alerts, that is an amazing way to support me. It helps improve the algos and the way that they recommend my channel to other people. Also, which makes me feel good because then my subscriber numbers keep going up. We're getting close to 20,000. I have 19,400 or something like that. And we were at 18,000 just about like 2 months ago. So we're doing really great on subscribers. I can't wait to hit 20,000. It's going to be amazing. So please share it with your friends. If the 177 of you shared this channel with 3 of your friends, we would hit 20K immediately. Scrolling down here through the chat. Bro, Dow is outperforming S&P 500 and NASDAQ because of the Russell. The Russell has been bouncing. That's true. But, the Russell, whenever people point out Russell outperformance, I think it's important to note where it's outperforming from. It's outperforming from multi-year lows, right? Or, it's at the 2022 lows, essentially, just hanging out here. And it's easy for stocks to outperform off of low levels. It's also worth pointing out that I don't think any members of the Russell are in the Dow Jones. The Dow Jones is 30 very large companies. I don't think any of them are in the Russell 2000. Oscar Hernandez with the dono. Thank you, my brother. Always a supporter of the channel. Eric Martinson, another big supporter with the dono. Let's open up the memberships. That's a great suggestion, Eric. And thanks for your first super chat here on the stream. I've thought about opening up the little membership thing, for like $5 a month just to have like an icon. What I need to do is I need someone to make me some channel icons. I probably need to go on Fiverr or something like that and hire someone to produce a few icons for the channel, like a subscriber icon for 1 month, 3 months, 6 months, a year. And then also maybe, 3 to 5 emojis to use. I haven't done that yet. And so I didn't want to open up the memberships to you guys and not have anything to offer you other than my content that you're getting for free now. And so I didn't really know what to do with that. You sign up for something and then nothing changes. We could do membership streams if we open that up and we eventually get there. I wouldn't want to charge you guys a lot of money. I would just wanted to make it like an option for you if you feel like supporting the channel and being, having like an icon next to your name. I'm more than happy to do that, but I don't want it to feel like a scam either. So I haven't been in a hurry to just open that up. But that is a good suggestion. I appreciate that. Oscar with another donut with the $5. Appreciate it, my dude. Thank you so much. So all right. So that's kind of what's going on with the markets. We got really strong closes. We looked at the Dow close, but I think it's just worth looking at the other two real quick. We looked at the Dow monthly close, noted that it is above the levels from July, and I think it makes sense now that we just look for the highs. But if we go look over here at the NASDAQ, look at the NASDAQ. That's just crazy. That's just an absurd bounce right there. The close was above the wick right here, just barely got over it. Look at that. Barely got over it. That's a bullish close. And that's on the index. That's not on the future. So you like to see that. S&P, a little bit less impressive. But that's what we want, right? We want to see the NASDAQ and the Dow Jones outperforming the S&P. It doesn't have to be that way. But if we're going to tick all the boxes on what we think is going to happen, that's the thing we would want to see. If the S&P continues moving, whatever. But from describing these dynamics as we have, I would expect that if there's any truth to it, that the S&P will lag behind. And right now it's doing that a little bit. It's suggesting that it wants to lag behind a bit. So that's fascinating to me. A lot of this move, I think it's important to point out, a lot of this move is because yields have been absolutely crashing, right? If you look at the 10-year, it's been eating shit. Now that's a bid. The yields have been eating shit. So when the yields are coming down, that means people are bidding the 10-year, right? If you look at the 10-year, this is the 10-year. It's getting bid. See that? Straight up. So it's getting bid. Yields are coming down. And not only are yields coming down, but also real yields are coming down, which is the inflation adjusted yields, because inflation expectations are falling and yields are falling. So it's just all coming down. And on a monthly perspective, this 10-year move in November, that was a 12.26% drop. We haven't seen one that big since July back here. 12%. And this was bigger than that, actually. The last time we saw 12% was back here in July of last year. The last time we saw 12.2 or more was in COVID. So that's a massive move down in yields from cyclical highs, literally from the cyclical high. And during that month, we had a massive rip in equities, right? You have one of the biggest falls in the 10-year in the last 3 years, and you just so happen to have an almost 9% month on the Dow Jones. Those things go together, right? Those are related dynamics, and they are centered around the expectation that the Fed is done hiking and that the economy is still going, and we're probably going to have a soft landing. This is what people believe. And as a result, we're bidding assets, right? Because yields are going to come down. That fundamentally allows us to reprice risk higher. And we're excited about the future. So let's buy risk. Let's just ape into big tech. So that's partly what we're seeing here. Luigi says there should be 2K people in this chat right now. You know, I appreciate that, Luigi. We'll get there, my guy. I feel like if we keep doing these streams and the 180 to 200 of y'all that show up every time keep showing up, then we will eventually build up to having 300 or 400 people here, to having 800 people here, having over 1,000. I'd like to get to that point. Maybe for me to do that, I have to do more live streams. I don't know. Maybe I need to do a couple of them a week. I haven't quite figured that out yet, but being consistent, I think, is the first start, and I haven't always been consistent. So just trying to establish a good cadence, and hopefully those things will grow from there. Just to touch on DXY here. We're about halfway into this. I'm going to try to keep this to an hour and 15 minutes. I'm tired of keeping you guys for 2 hours. That's a lot to ask of you. And it's a lot to ask of other people to re-watch a stream they weren't here for 2 hours. So I'm going to try to keep this another 30, 45 minutes, and then we'll dip out because it's a Saturday. DXY is still moving down. What we've been talking about on the DXY is whether or not we're going to continue with the Wyckoff spring move higher. Right. We've looked at the Wyckoff schematic and how this was the sign of strength. And if you look at all the crypto charts like we were looking at earlier, this is where they are, right? They're all currently hanging out at sign of strength, waiting to load the next leg higher. And we'd been waiting to see what DXY was going to do. Now that it's broken down to the midpoint here, it's pretty clear it wasn't just about to continue and rip higher. But now what we really would need to see, if you're a dollar bull, what you'd really want to see is for this area here to hold, this kind of midway of the range. If we started to see price breaking down below these levels and forming multiple candles, then I would be looking for the lows, and I would assume that would help to lift risk assets. There is still a possibility that it reverses and goes higher. It is still technically in it's trying to form an uptrend here. We'll find out. But DXY has been a little hard to read. And you know, I think that we're just kind of in the middle of a range right now, so it's okay to be a little uncertain about it. So all this move in equities, I've been trying to get my thoughts together. You know, we've gone through the charts, and you guys know what I think. What I think is that we are in the topping phase of a secular bull, that we are not at the beginning of a new expansion. And that can be a really confusing period of time. There can be a lot of mixed signals in a time like this. And I think that we're getting to that point when you see this candle on the Dow and you see how close we are to the all-time high. How close? I bet this is 2%. Wow, it is. Look at that, 1.9. When you see how close it is to the all-time high, and you see how many people are talking about soft landing on Twitter and even in Wall Street, like if you look at estimates from the different firms and banks and things, they're all projecting a soft landing. There are 4 or 5 rate cuts priced into next year's market. The market just assumes that the Fed is going to be surgical in their cuts and that it's going to produce a soft landing. I am less sanguine about those outcomes. I see you guys dropping the frogs. That's amazing. All right, Sick Thanker. Have a good weekend. I appreciate you stopping by, brother. We'll see you again next time. I think we're entering a really dangerous phase of this market. Valuations are still very high. I've told you guys that if we start a bull market from here, a new multi-year expansion, it will be from the highest price to earnings ratio that the S&P has ever been at the start of a bull market, ever. And that has great implications for the market's endurance and how high it could potentially go. Because valuations do come home to roost. Fundamentals eventually come home to roost, and they haven't yet. And I think that we're about to enter that euphoric phase. If equities make an all-time high, while certain parts of the economy continue to trend as they have, then I think that it makes it really clear to me that we are in a late cycle topping phase. And I don't believe that we're going to continue on for the next 2-3 years into an expansion. I do think the economy is not going to be able to continue to expand, and that sometime next year, many of these fundamentals will come home to roost. Like I said, we're seeing it in rates of change. And I think I'm trying to position myself for that. Like, I'm long the market, right? I'm long crypto, I'm long Bitcoin, and I will de-risk out of most of my altcoins and some of my Bitcoin, the stuff that I've chosen to trade with. I'll de-risk out of some of that stuff when we get a little bit higher into the retracements. I have some puts on Apple and Microsoft, and part of that is because when you go look at them, let me look at them over here. When you look at like Apple and Microsoft, they have these, look at Apple. This is a monthly chart for Apple, right? It's had a multi-year bearish divergence on the monthly chart for Apple as we push up. The high on RSI on a monthly basis for Apple was the COVID recovery. When you look at it for Microsoft, it was back here in 2018. And this is kind of a similar dynamic to some of the other big tech. Is it Google? Was Google one of them? I can't remember. But it just looks like some of these tickers are really overextended, right? We've seen these long-term bear divs on Microsoft. You can see it here as well. This long-term bear div on Microsoft. There's one on Apple, this long bear div on Apple. We got a higher high right here, but then if you look on a monthly chart, it's a bear div. As we continue to push higher, RSI keeps making lower highs. And those are the biggest companies. These are the 2 biggest companies on earth, right? That has me pretty concerned. The high on monthly RSI for Microsoft was 2018. That was before COVID, right? The same thing I think as NVIDIA. NVIDIA, look at NVIDIA. The high on monthly RSI for NVIDIA was 2017. And then it set a lower high in November of 2021. And then while it set an all-time high in August, it was another lower high on the monthly relative strength. And it feels like Bitcoin to me, like this part of Bitcoin right here, where we moved up, we pulled back, we're pushing up and making a second higher high, but there are bare divergences on relative strength. And it feels like that to me. While we also have witnessed this dynamic, we're all the way up here, and the economy, the rate of growth of the economy is below trend. That recipe, it just tickles something in my brain. It just says, that just doesn't feel right. It just doesn't seem right. Now, I know the market can be irrational for long periods of time, but eventually there is a reversion back to normalcy. And trying to guess when that is not really what I'm trying to do. I'm trying to evaluate the likelihood of that happening. And it seems very likely that we're near the end of a cycle rather than the beginning of a new one. Can I share how I created my puts? Yeah, I can talk about it a little bit, but the problem is that I bought them. I bought them like a month ago, and I wouldn't want someone to do exactly what I'm doing. But I have puts on Apple and Microsoft. I'll put them up here. I have puts on Apple and Microsoft. They're both for April, May expirations. And for each of them, I think my Microsoft puts are for 165 and 170 here. Apple, sorry. 165, 170 for Apple here. And on Microsoft, I think I have two or three. I think I have one for 310. I think I have one for 325. And I think I actually have a 290 or 285 one for this gap here. I'm okay with them expiring worthless because I'm long the market. So it's my downside protection. And the reason I chose, April, May expiration is because that is near the end of the timeline for examples of when we've had recessions in the past. Now, I don't know that the market will necessarily roll over before then, but that was just a place where I identified a good softness between my timeline of general expectations and the pricing of the options. But what I'm willing to do if price continues to go higher. Now, Apple and Microsoft don't, like, Apple looks a little stronger. Microsoft already made a new high and it's rolling over a bit. If it doesn't continue to go higher, then I'll just keep what I have. But if it does push higher over the next month or so, protection will get even cheaper, and I might just buy a couple more of them, right? It's a percentage of my trading account that I have exposed to options. I didn't go YOLO like 50K in fucking options. It's downside protection. If they expire worthless, then it was a calculated loss. If I actually make something off of it, it's because the market is falling and I was correct and I've protected myself. Yeah, so April and May, part of that is because if we go look at when the yield curve inverts and we look at when we've had recessions, based on that, the furthest out we've ever gotten from the inversion of a yield curve is about 18 months. And if you add 18 months to October 2022, it puts you in March of next year. Now, the beginning of a recession is not always the bottom of the market, but I was trying to just kind of pick a time frame. And if I get some other protection, I might buy them for a longer expiry. I might get them for May or June expiration. I'm not an expert on options. I'm just trying to think through all the different scenarios that I want to be prepared for. And that's one of them. So that's kind of how I'm thinking about this. And from a growth perspective, sorry, I got so many charts here. Here we go. From a growth perspective, we are below trend in terms of tightening cycles. So this black line is today's growth in the economy relative to the beginning of Fed tightening. And these other two lines are prior eras where we had low or average inflation and high inflation. And until very recently, We were below trend on growth on all of these things. We are below trend on growth on employment. This bottom here is just employment. This composite growth is all of the measures used by the NBER. So it includes labor, it includes real income and real consumption. It also includes things like real retail sales and industrial production, things like that. And it has started to tick a little bit higher here, which I think I've noted some people identifying and saying, wow, look, the economy is reaccelerating. But that's not what it means to me. So if I go look at some of these cyclical pieces over here, let's look at them here. We've got industrial production, manufacturing sales, which is wholesale, retail sales, and then all of them combined into something called cyclicals. And you can see relative to when the yield curve inverted, this vertical line, for much of this saga, the black line has been below the gray line and the gray area chart, which means that the black line being today and the gray area, the gray line being the average of all prior eras, for much of this saga, we've been below trend on cyclical growth. The leading parts of the economy, like that you see in the manufacturing PMIs, they've been telling a very negative story. Just recently, the growth rates, now they're still below their highs, but the growth rates on some of these have started to tick higher. And that's because they led so far in advance. Like real retail sales looked recessionary a year ago. Like it looked bad a year ago. And so it's starting to recover a bit in rate of change terms in the leading parts of the economy. But if we look at other places like labor is not showing that trend. Labor is continuing to soften. This is non-farm payrolls. This is the household survey, which is the other measure of labor. This is wages, people's income on a weekly basis. So hours times weekly earnings, hours worked times hourly wage. That is continuing to decline. And then if you go down to unemployed persons, it's rising faster than normal. So it's the reverse. We want to see that lower. It's rising faster than normal. Job losers, it's accelerating in a recessionary way. Part-time for economic reasons, accelerating in a recessionary way. This is what we looked at in our stream last week, where I showed you this chart, where we had all of those labor components, temporary workers, job losers, unemployed people, long-term unemployed people, job vacancy rates, and all of them were in rates of change that are only seen as we enter into a recession. So we're in a bifurcation right now where the leading parts of the economy and even some of the coincident pieces are pointing in a particular direction that the markets are simply refusing to accept, because the markets right now only care about the Fed and whether or not they are going to get the amount of cuts that they have priced into next year. When we were looking at this, let me pull up the FedWatch tool. Let's pull this up, FedWatch. So here we go. Right now we're at 550 on terminal rate, right? And when you look forward to the meeting in January, March, May, June, July of next year, this blue box represents the current strongest probability. And what you'll note is that the blue box starts moving to the left as we go down the table. What does that mean? That means that the terminal rate is getting smaller as we move forward in time. So as we go forward to each of the next Fed meetings, that's all the dates here next year, the terminal rate is expected to continue falling in 25 BIP chunks, meeting after meeting after meeting after meeting after meeting. They expect the Fed to begin a surgical cut of interest rates that lasts through most of next year and that allows the economy, the markets, to continue to see 12% earnings growth over the next 2 years, which is what they have priced in. And if any of that stuff doesn't play out, as well as CPI continuing to disinflate even though it has almost disinflated all the way back down to 2 to 3%. People expect it to continue falling all the way down below 2%, 0%. Who knows what they think. And so the market's pricing in this absolute perfect Goldilocks scenario where the Fed is cutting as soon as March. They begin cutting right here. That's what this means. 55% chance they cut 25 bips at the March meeting. 42% chance they cut another 25 bips a month later, month and a half later, and that they just keep on going. And so if anything interrupts any of that, the market will need to reprice. But it so far has an absolute perfect Goldilocks priced in right now. And I think that is exceedingly unlikely. Not only is it unlikely, but it might be the longest of all long shot odds that this is exactly what we get. So I do think the Fed is going to cut rates. They're going to cut at some point next year. There will be a cut somewhere, I believe. There could be more than one. And the market will interpret that very bullishly, as they do, because they're currently obsessed with the Fed. They're obsessed. That's why we started a pause rally at the beginning of November when the Treasury was still issuing duration. They just weren't issuing quite as much. All that matters is Fed easing now, and the market's being given a break by the government, by Yellen and Powell combined. And that's all the market is really focused on. So I kind of lost my train of thought here, but I think that the outcome being expected doesn't likely match what we're going to see, because here's what I was going to say. So when the Fed begins to lower rates, what we need to ask ourselves is, will that be enough to be considered easing? Or will it maintain a policy stance, right? Like which one of those two is going to happen? So if we look at a real Fed funds rate, let's do that real quick. Let's do CPI less energy food. Where is it? Hold on. CPI food energy. I'm trying to find core CPI. Why is it so hard to find? Consumer price, food, energy. Here we go. Food, energy. Where is it? Man, this website sometimes. I don't care about Europe. Give me the United States. CPI, core CPI. Here it is. Sorry. It's this one. All right. Fed funds. I want to show you the real Fed funds rate. I'm building the chart in real time, so you guys just hang with me here. Add CPI, core CPI. Let's change that to percent of change year over year. Percent. Perfect. So A minus B. There it is. All right. This is the real Fed funds rate. This is the real rate according to core CPI and the Fed policy rate, Fed funds rate. So we have, according to this measure, real rates are restrictive about 1.5%. If you use regular CPI, it looks higher than this because regular headline CPI is below core CPI. But it's also a lot more volatile. So let's just use core to have a measure that isn't quite so volatile. So either way, it shows a restrictive stance. And in theory, if you're thinking about this from a policy perspective and not from a binary rates down bullish, rates up bearish, just think about it from being restrictive versus being accommodative. If you're a policy maker, you are either leaning against economic growth or you are leaning away from economic growth, right? You're either pushing back against it or you're encouraging it. Right now, with policy rates where they are, theoretically, you are leaning against growth just a bit at about 1.5%. But for the Fed to maintain a restrictive stance while CPI continues to fall, which is the denominator of this metric, it's the adjustment of this metric. If CPI is falling, then that's going to, and you don't change the interest rate at all, it's going to make this go higher, right? Because the number you are adjusting this by is getting smaller. So the real rate will climb as inflation falls if they don't do anything at all. And that will be a passive tightening. Does that make sense? So the Fed, right, their rate is largely guided by inflation and the rate of growth of the economy. And so if you think about, well, we raised rates to fight inflation. We raised them up to 550 basis points. If core inflation is still at 4%, then you have a real rate that is 1.5, right? Fed funds is 1.5 above inflation. Well, if inflation falls another 1% down to 3, then your Fed funds rate, your real rate of policy, jumps by 1% and it becomes 2.5%. So the Fed, if they want to, according to their language, maintain a restrictive stance, which is the language that Powell has been using in his pressers, then they will need to lower rates slowly as inflation is falling and maintain this line here, somewhere in this little area right above 0. And so I think they're going to cut a bit next year. They're going to cut a little bit here or there, and some of that is what the market's pricing in here. The question is how much that will be interpreted as a straight up pivot, and whether or not that's actually going to be enough to allow the economy to continue growing. I don't know that it will be. I also am not sure how many cuts we will get. This is an area where we don't have a lot of history to go off of. So anyone who has a strong opinion about what's going to happen over the next year is just speculating purely, right? We've never really been in this exact scenario, and we don't have evidence of a Fed surgically and pragmatically lowering rates to maintain a restrictive policy stance that doesn't move, that just stays just barely restrictive. And I think because of the existence of inflation in this era, it's likely that they will be more cautious about easing. Right? I think there is an expectation that the Fed is going to, at the first sign of weakness, they're going to open the floodgates. You know, a lot of times I see there's this GIF that I see shared a lot of this water main that is broken, and there's just like hundreds of thousands of gallons of water blasting out of it. And people always show that GIF when they're referencing what they think the Fed is going to do at the first sign of a recession. And I'm not yet on board with that line of thinking. Because if you look back through time and you look back at like when we've had inflation in the past, the response function of the Fed has been delayed because of the existence of inflation. They have not been quick to ease. And even though CPI has come down quite a bit, it's a factor in this cycle. We still have wage growth over 4%. That's twice the inflation target. We still have strong consumption numbers, even though inflation has come down a bit from where it was. It's not at 9%, you know, it's at 3 to 4%. It's still too high. And that last 1 or 2% will be difficult to get to and hold. The Fed knows that. That's what history tells us. And so I think because inflation exists now, and it didn't exist in 2020, it didn't exist in 2019 when we had the Powell pivot. There wasn't really much inflation in 2007, 2008. But even then they were worried about it. It was only 3-4%, but even then they talked about it in the FOMC meeting minutes back here in 2007. They started cutting right here. And even during this cutting period right here in the minutes from the FOMC, you can see Bernanke and the other governors talking about, man, inflation is at like 3.5%, 4%. If it rises much more, we're going to need to raise interest rates again, even though subprime is collapsing. So like that's their number one nemesis. And if it's existing in this cycle here where it hasn't before, why do we expect them to have the same response function they had in a low to no inflation environment? Those things don't line up for me in my brain. They don't pass the smell test. Now, maybe I end up being wrong, but that's kind of how I think about it here. And I think for that reason, because when you think about what the Fed did in the 70s, Their response function will be delayed. Just look at 1974, right? Here's the recession. The recession began here. This was the top of the Fed funds rate. The recession began in November of hiccups. The recession began in November of 1973. The high of Fed funds was July of 74. It was 8 or 9 months later. And the Fed, they weren't easing until back here, right? Then they started to ease off the pedal a little bit. It was well into the recession. I think something closer to that is what we will see this time. And because of that, it will naturally not look like 2020. Let me go back and look through the chat here. So it's about 11. We'll go for another maybe 10, 15 minutes. I want to make sure I get everyone's questions. I want to make sure we wrap up with all the final thoughts we have, and then we'll save the rest for next stream. We're not going to do a 2-hour stream today. All right. So we see JB Estrada in the chat said, what books do you recommend to learn how to invest in trade? So that's a tough one. I've never read a book that taught me how to trade. Trading has been a multi-year learning process for me, and I talked about that some in a couple streams ago. I was really honest with you guys about how I'm not a master trader. I don't have it all figured out. I am getting better, and I've been putting a lot more effort into it recently, and I really feel that improvement building. When I focus my brain on something, I can really get results. But it's a long process. Now, there's plenty of books where you can read about financial history. You can start to understand the cyclical nature of markets and human behavior and how we kind of just do the same things over and over again. But in terms of trading, there isn't really a book on trading. There are books on investing and just being a smart market participant. And depending on where you are in that part of your journey, I could recommend certain books. One book, this is not a Investing 101 book. This is a book for people who have been hanging around the markets for a little while, but maybe they don't have very many best practices. Maybe they're still trying to figure out, like, how do I deal with risk? What does it mean when everyone's getting really excited? Should I also be excited, or should I be more cautious? Like, just kind of thinking rationally about the market from someone who has a lot of experience. This book, The Most Important Thing by Howard Marks, was awesome. I really enjoyed reading that. And I think that The Most Important Thing, Howard Marks. That book. Sorry, I didn't mean to close the window on you. This book here. And I read that. I also listened to the audiobook. It was really interesting. I learned a lot of cool things. Got a lot of great quotes about just general investing and kind of like truisms for someone who wants to be in the markets. So that's a good one to start with. I could probably recommend a lot of other ones. Like I said, it's not Investing 101, but it was a lot of wisdom from somebody who's been around since the beginning. Howard Marks has been around since the 60s. He saw the entire modernization of financial markets. So that's an interesting person to listen to and to learn from. Michael Campbell says, TX, are you still short the Dow? Well, I wasn't short the Dow, but a couple of weeks ago, I did have a brief, I had a trade where I was short the NASDAQ, but I cut that trade because these wicks here stopped me out. It was just a trade. And I haven't gotten back in, and I won't probably reopen that trade until I see a cleaner entry on the higher time frame, because I had entered that trade on the daily and I got stopped out, and I haven't yet seen the same triggers. And so I've decided to hold off because of what we were talking about at the beginning of the stream. I think markets are going to go higher from here. I would rather see a swing failure on a weekly chart. And if that's the case, depending on where it is, if we have just swept a key level, then I might reopen my short. Like right here, if we suddenly got like, let's say there was a candle like this. I'm going to draw a candle for you. let's say there was a candle like this. Wake up. Oh, okay. There it is. Let's say there's a candle like this, right? And it was a red candle. It opened here. It swept these highs, and then it closed down here. And that was the end of the week. And that was Friday afternoon. If I saw that, I would probably open a short, and I would target, maybe here and then here with an invalidation on a clean break there above this level. Because that's a short, it's a swing failure, right? A sweep of highs and a close below the previous candle. That's an obvious swing failure on a high time frame. If I see something like that, regardless of where I think the market's going to go, that's a clean short setup to at least this level right here. That's kind of how I would look at that. BCB, I see you in the chat, bro. I was showing them this a little while ago. I was showing everyone the NASDAQ X SPX and how, you and I have been talking about scenarios that might let us see the NASDAQ and the Dow Jones outperform the S&P over the next few months, next couple of weeks, however long it takes. And how one potential avenue for that, which doesn't have to happen, but could certainly happen, to see the NASDAQ outperform the S&P would be for the stocks that are in the index, not in the S&P, to outperform. And so I made this indicator, and I was showing them how this lined up with Bitcoin and how remarkably this pivot lined up with this rollover point for Bitcoin, how this peak lined up with this peak for Bitcoin. This is within like a week. Where they really line up, where the really freaky ones line up, are these two over here, where the absolute peak of this series was the high from September to the day when we had a 10K red candle on Bitcoin. And then the other peak, the retrace peak for this series, was to the day, the Bitcoin all-time high. And how each of these gaps from this peak to Bitcoin peak, from this trough to Bitcoin trough, from second peak to Bitcoin second peak, we're all about 60 days. I think it's kind of interesting. Don't really know how to forecast with it. I think it's more something that I'm just going to keep an eye on and watch and see how it behaves relative to what other things are doing. But the fact that it's down here at the 702, while the NASDAQ is wherever the fuck it is. Where's the NASDAQ? I think it's well above that. I think it's like closer to, like whatever 80, 85 would be. Yeah. It's way up here, while this one's way down here, suggests that maybe it's going to catch up. And if that's the case, maybe this outperforms this. And we start to see it push up to the highs and maybe even make a run at 18,000. Maybe the Dow makes a run at 39.5. That'd be amazing to see. But if that continues to happen while this continues to go this way, then, boys and girls, a story is being told to you whether you want to hear it or not. When we have unemployment and long-term unemployment in this cycle already rising at a faster pace than almost any other era relative to Fed tightening, a story is being told to you, whether you want to hear it or not. And the fact that it may take months to play out doesn't change the ultimate story. That's what informs my bias. Nothing that's happening in the markets will change the recession outlook. And that's probably one of the most important points that I can make for folks who have been following my content for any length of time. The most important point I can make is that the stock market is not an altering factor in the ability of the economy to turn down. There is no price on the S&P. I hit my mic. There's no price on the S&P that invalidates a recession call, frankly. because most recessions begin within 5 to 8% of the all-time high on the index. Like that's when, in retrospect, they say that's where the recession started. You know, it's not always obvious, but once we get all the data and we go back and look, that's around the point of time where the NBER says that's about where it started. And it's usually within 5 to 8% of the all-time high, which happened in that cycle. And it's usually just a month or two after that. So nothing about what the S&P is doing says anything about recession. And if you see people making those linkages in their content or in their tweets, they don't really know what they're talking about. Straight up. You can't have a thesis without an invalidation. Yeah, that's true. That's true. If the yield curve uninverts, employment begins to grow, consumer debt service levels begin to fall, and other things like delinquency rates, which are accelerating here at recessionary rates of change. If all that stuff reverses, then I think we can develop a new idea about the economy. But we're not in that place yet, right? We're not anywhere near that place, Rahul. So we have to take the data as it comes. You know, there's no reason to get cute with it. And you didn't say this, but I'm giving you my context. When I see transitions into serious delinquency on this rate of change, that bothers me. When I see cyclical areas of the economy, which is the manufacturing PMI, in contraction for 15 months while the market continues to climb higher, this is the leading parts of the economy, and they don't look any better. That's concerning to me. When I look at the services economy, which lags behind the manufacturing economy, and they are slowing down. Note the trend, friends. Note the trend here. Do I need to draw on this? Let me draw on this. Note the, oh my goodness. Okay. Sorry. Here we go. Note the trend. Like these are lower highs, lower lows, or lower highs mostly. On the services PMI, it is drifting down towards 50. Things are slowing down. If we look at the survey responses to the services sector, things are growing at a slower pace, most of them. New orders have picked up a little bit. Employment, slowing down. Business activity, slowing down. Services PMI overall, slowing down for 10 months. Where's the cyclical economy? Contracting at the same rate for 13 months. New orders contracting on an even slower basis. Slowing down a little bit. What's getting better? Supplier deliveries have been improving for 14 months because the supply chain has been getting better. However, employment is contracting at a faster rate. Inventories are contracting. Customer inventories are too high. Manufacturing sector overall contracting at the same rate of change for 13 months. That's happening while the market continues to go higher. We've never had the PMIs under 50 for this many months and not had a recession. Never. So there's plenty left for us to see and determine whether or not our thesis has been invalidated. The indicators you've stated are all lagging. Rahul, I think maybe this is your first time listening to me here. We have established parts that lead, parts that are coincident, parts that lag, and we've modeled all of them. I'm just showing you a couple of them to make my point here. You know what else leads? Credit. And it's currently below every prior era. That's another piece that not many people talk about. When you look at it from the rate of change of tightening, we're right here. Commercial and industrial loans since the Fed began tightening have slowed down at a pace from relative normal rates of growth up here, have slowed down at a pace that we have only ever seen the last time we had a pandemic of any kind. It was the flu pandemic in the 50s. It's the only other time credit slowed this much, this fast. That's business loans, right? It's similar if we look at all credit. Doesn't look much better, right? Looks kind of the same. It just hasn't hit the zero bound yet. But it has slowed faster than every single other era, except the other time we had a pandemic 70 years ago. So leading parts of the economy are telling an ugly story. Coincident parts of the economy are still positive, but some of the rates of change don't look good at all. Other areas of the economy look really bad. Imports down here below most other eras. Exports also down here below most other eras. World trade just looks bad, right? Long-term unemployment, well, I showed you this chart already. It's this chart here. Long-term unemployment and employment rates of change. These are lagging indicators. These are the last ones to move. Their rates of change are already faster than all other eras, right? These are leading components of the labor market. Job losers, temporary workers, even vacancy rates. All of those things are in recessionary territory. And none of them have changed in several months now, while we're seeing these delinquency rates accelerate. And even so, like if we go look at this. Look at auto loans in serious delinquency and look at the blue line and the red line at the top. You see that? 18 to 29, 30 to 39. So basically every adult under the age of 40, on a national level, adults under the age of 40 have auto loan serious delinquency rates that haven't been seen since the worst parts of the GFC. Look at that red line. Look where it is. Look at the blue line. Look where that is. And it's accelerating. It's going up. It's on the front side of the move, right? That's auto loans. Here's credit card delinquency. Same two lines. Look at that. Under the age of 40 adults, look where these two lines are. They're above the last 15 years. 14 years, however many years it's been since the GFC. And they're still accelerating. Every age group is accelerating. But under the age of 40 is already broken into new highs. Something is coming this way. And delinquency rates, refinancing of houses, all of those things, they need a lot more than 100 basis point cut in Fed funds to re-stimulate those parts of the market. They need hundreds of basis points of cuts. Hundreds. They need us down into the 2 to 3% range because most of these loans were taken out at rates there or lower. Particularly mortgages, right? No one with a 2.75% mortgage rate is going to refinance if mortgage rates fall to 4.5%, 5%. They're still locked in. The refinancing channel is a major form of stimulus early in a cycle. You have to ask yourself, are we going to get enough cuts for those things to be reawakened? Are we going to get enough cuts so that every business that termed out its debt in 2020 and 2021, when corporate yields were less than 50% of where they are today, everyone who termed out those debts back then, is that going to reawaken the credit edifice if we only get 100 bips of cuts, 150 bips of cuts from 5.5 down to 4% Fed funds? Is that going to be enough? I wager that it will not. I think that there aren't enough conversations that I hear asking those specific questions. So, all right. I'm starting to wrap it up here, guys. If you have not subscribed to the channel, please do so. please enable the alert icon so you can find out the next time I book a stream. Hit the like button. I assume you have, because we have 193 likes and we have 180 viewers. So that's amazing. Thank you. And we'll probably do another stream during the week. I want to keep the Thursday, Friday window as like the most regular time period. If you guys prefer Saturday streams, tell me in the chat or leave a comment on the video afterwards, or DM me on Twitter. Just let me know somehow. And I'll take that into consideration if enough of you say that. But for now, I'll try to keep it consistent, and we'll look to do the next stream later this week before Saturday. Yeah, another problem coming up is all the people getting ready to retire, just relying on Social Security alone with no savings. Yeah, Clifford. Oh, one last thing. One final thing I did want to talk about. It's related to what we were just looking at with all these credit card delinquency. So we've been talking about the credit, consumer credit, and how consumer debt service is getting really high. I think I've talked to you guys about that before. Let me show you real quick. Personal interest payments. Credit graph. Disposable personal income. So this chart represents all debt that is not mortgages and how much it costs to service that debt as a share of people's disposable income, right? Personal interest payments, which is not mortgages, over disposable income, your debt service costs. And you've seen how it's risen, right? I've shown you guys this chart before. This is a major source of credit stress because back here in April, May 2022, people were spending 1 to 1.5% of their disposable income on non-mortgage debt, and now they're spending 2.5%, 3%, 2.8%. So it's doubled the amount of people's disposable income that is going towards debt payments has doubled in a year. And so what I wanted to see was Adobe Analytics and their Black Friday numbers, right? We just had Black Friday sales. Look at this. Adobe Analytics shows record holiday spending, with Cyber Monday growing 9.6 year over year to 12 billion, and Cyber Week overall up 8% year over year to 38 billion. Buy now, pay later. This is the part I want to talk about. Drove 940 million in online spending of the 12 billion. So it was about 8% of Cyber Monday, up 42% year over year. Buy now, pay later is that small loan that you can get at the checkout counter that turns your payment into like 4 or 5 monthly payments. It's like an instant loan so that you don't have to pay in full at the register. And this is becoming an increasingly popular choice among consumers. It's up 42% year over year. It was 940 million of the 12 billion of sales. 9.4 divided by 7.5, 7.6%. That's a big chunk. What does it say here? While consumers showed a strong appetite, many are giving themselves flexibility. BNPL, buy now, pay later, contributed 940 million. The number of items per order rose about 11% as shoppers use it for increasingly larger carts. November 2023 is expected to be the biggest month in record for the payment method. So everyone's got credit cards, right? But the average credit card rate in this country is higher than it has ever been. Where is it? Commercial bank interest rate on credit cards. See that? 22% national rate on credit cards. So what that creates is a dynamic where you've got all these people, where's the chart? You've got all this excess credit card capacity, which is these gray bars here. All this extra credit card capacity, but people just aren't tapping it. That's the dark blue bars. They're just not tapping those credit card balances because they don't want to pay 22% on their monthly payments. So instead, they're going to buy now, pay later, which if you pay it off on time, doesn't charge you that interest. But with 940 million in sales in a week, and it's up 40% year over year, I got to think that we're going to see more delinquencies in this market that's now just posted almost $1 billion in sales. And what were we just looking at? Accelerating credit card delinquency, particularly in young people who are the main users of shit like BNPL. This is a late cycle dynamic. We don't know how this is going to unfold. But I can't just put all this aside because I think the Fed is going to cut, which historically is not bullish, and buy into the new bull market narrative. I'm just not there. So that's where we're going to wrap up today, friends. We'll keep our eyes on NDX, S&P. We'll keep our eyes on these other indexes after their really strong monthly closes. And, you know, what I'm mostly interested in these days is watching this Bitcoin move. This is a really strong weekly trend. It's just a relentless grind higher. There's a lot of bulls who keep waiting for pixel perfect pullbacks to get their entries, and they're not getting them. And each time we break out, somebody has to buy in at a suboptimal place. And, you know, when we get into these retracement levels up in here, I think the euphoria is just going to become ridiculous. Same thing if we see equities, which are only 2% away from their all-time highs. They will be at all-time highs in this area, most likely. And the media machine is going to go into full fucking steam. It's going to be hard to hold on to a bearish outlook if you have one and if data supports it, because the sentiment will be screaming the polar opposite. Money is in money markets because that is where the yield is most attractive, rational evidence. So you have to think about the equity risk premium, which is a function of expected earnings and other yields, right? Like the 10-year benchmark. And right now, the equity risk premium, the benefit of buying equities over bonds, is one of the lowest levels it's been in like 30 years. Because you can get a 3-month T-bill at 5.5%, and the equity risk premium on the S&P is like 5%. So money is always deployed where investors want it to be. Like this idea that people just are, because it's in a money market, that's like untapped stock market demand is just simply not true. It's not true. If that money wanted to be in stocks, it would buy stocks tomorrow, yesterday. It's in the money market fund. It's there because the risk-adjusted return of being in money markets is currently very attractive relative to the risk-adjusted return possible on the S&P at its current valuations. A normal pullback of BTC from 48,000, which is retracement levels, still puts us above 30,000. I don't know what you mean, why that has to be 48,000. That's not even a 50% drawdown. I'm not sure what you're thinking about there, Rahul. Maybe we can talk more about that next time. But my thesis about Bitcoin is based on what stock markets do in every single recession, which is set new lows off of the cyclical lows that were already established. And so if that plays out and I'm correct, then I will assume Bitcoin will follow it. Because Bitcoin follows tech stocks. So if tech stocks break down, Bitcoin's going to go with it. Some people will bid Bitcoin because of the sound money, outside money principle. But just as many people will sell their liquid assets because they will need cash. If we're correct. And we still have a few more months to see that play out. So with that, I thank you, friends. Thank you so much for hanging out here today. I will look into setting up channel memberships, but like I said, I need to get some icons made. I don't have any artistic ability, so I need to get some membership icons and maybe some emojis that we can use in the chat, and then we could turn on chat subscriptions for anyone who would like to do that. And then maybe we can start doing like a once monthly or something like that membership stream where we do other stuff, talk about other things. I can be more transparent with, you know, some of my data or my charts or whatever you guys want from that. But I thank you so much. Thanks for the feedback in the chat, for making this interactive. I appreciate all the questions. I'm just a man on the internet. I don't claim to have any secret sauce or any secret knowledge. Please do not base your investments on things that I say. Do your own research. This is my research. I share it with you because I enjoy doing that. I don't want you guys investing on my advice. I'm still trying to figure things out for myself. But we take a rational, data-driven approach on this channel, and we will continue to do so. Thanks, everyone. Until we meet again, take care of yourselves, take care of each other. Call your mom. We can't all do that. Some of us don't have our moms anymore, but it's the holidays. You got to call your mom. And we will talk again in a few days. Love you guys. Look forward to seeing you again. Cheers, everyone.